Hello all, welcome to the webinar on cash flow based lending versus asset based lending that's going to be conducted by Vanita Patel from MyCFO. She is a chartered accountant with 5 years experience in India with companies like L'Oreal. She also has 5 years experience in US on collateral exams including surveys and pre-funds. She's comfortable with the topic and would like to share her experience on what banks look for and what's best for your organization. Over to you, Vanita.
The sketch for the presentation today. We'll look at what is cash conversion cycle, what is cash flow lending and asset-based lending, how they are different from each other, the advantages and disadvantages of each option, and the scenarios where one is more preferred method to the other, borrowing-based calculation, and finally I'll be happy to take on questions if any. You can see on the screen the cash conversion cycle in a way of a diagram. The cash conversion cycle is a cash flow calculation that attempts to measure the time it takes a business to convert its investment in inventory and other resource inputs into cash through sale of goods or services. In other words, the cash conversion cycle measures how long cash is tied up in inventory before the inventory is sold and cash is collected from customers. Before a business receives payment for goods, there are a number of items to be considered. Like companies typically know that their business has to pay their supplier on order, which means they need funds for purchasing goods upfront. In addition, it may take some time to receive and sell these goods. If it's manufacturing business, we should also take into consideration the amount of time it takes to produce a final product. In the cash conversion cycle, there are some situations where the business has to sell goods on credit, which means it can take even longer before the business actually receives payment for the goods they originally purchased. Most business owners know exactly how long each step in the credit conversion cycle takes. They do not necessarily know how to transform and articulate this information as a finance need and determine when they'll be able to repay a potential facility. Looking at the diagram on the screen right now, it is clear that this business would not be able to repay any loan before the end of 60 days. As you can see, it takes 10 days to receive goods after you pay cash, raw material, 1 day to convert, 1 day sitting in the warehouse, and about 5 days processing time, 2 days to convert to finished goods, another 5 days, another 10 days to make sales, fetching customer, purchase order, sales order, 1 more day it is sitting to convert into invoice and book as AR. And then finally 31 days, assuming the terms is 31 days and your customer is good enough to pay on terms, you receive cash after 31 days. So that adds up to 60 days. If the business negotiates a payment term of order of goods or raw material, then credit days can be subtracted. For example, in our example, if we were to get the material on credit, say for 15 days credit, then my cash conversion cycle is reduced to 45 days in this example. This means it takes the business owner 45 days from paying for his inventory to receive the cash from their sale. This information applies to both asset-based and cash-based lending. It is important for financial institutions to realize that if they continue to provide financing to the companies based on assets or collateral with poor financial information about cash conversion cycle, then they will definitely end with a portfolio which is poor in repayment ability and default on the loans. So what is cash flow based lending? Actually, it is easier to understand this type of loan by explaining what it is not. Generally, banks make lending decisions based on a combination of factors, including your credit history, how much you have invested in the business, the collateral you have to offer, and the profit and cash flow of your business. They use this to determine your capacity to pay them back. It can be a fairly time-consuming process filled with documentation, and still many small businesses are turned down. That opens up the possibility for a new category of lenders that use a far narrower range of factors to determine your qualifications to borrow, concentrating almost exclusively on your cash flow instead of your assets. To be considered for a cash flow loan, lenders are primarily assessing the business owner's personal credit, the business credit, the consistency of cash flow. Lenders specifically will grant a loan based on future expected revenue that is anticipated from sales that can be determined by historical sales trend. So what we are trying to say here is that the collateral is not the primary consideration. The main consideration here is only your future expected cash flows. These loans generally do not require any type of physical collateral like property or assets. Instead, the lenders examine expected future company incomes and your credit rating. Banks usually underwrite cash flow loans by determining credit capacity. Typically, they'll use EBITDA, which is earnings before interest, tax, depreciation, and amortization, along with a credit multiplier to calculate this number. This financing method enables lenders to account for any risk which is associated with the industry sector or any downturns which may occur in the business cycle. Cash flow loans are generally suited to businesses that maintain very high margins or lack enough in hard assets. Typical industries are retail and marketing firms. How do cash flow loans generally work? With cash flow financing, you're basically borrowing against money you expect to receive in the future. And a lender will make the decision about whether or not to approve you based on those projections and your past performance. Lenders use computer algorithms that factor in all sorts of data, such as transaction frequency, volume, seasonal sales, expenses, returning customers, and sometimes even Yelp reviews. On the plus side, if your business has the sales to cover it, you may be able to qualify for a cash flow loan even if your credit is not that great. The application process is simple and you will have a decision relatively quickly. It could be even within 72 hours. Depending on the lender, you may be able to borrow anywhere from $500,000 to $1 million. The lender will be paid back a percentage of sales you make as you make them until the loan is paid off. While with others, you will end up paying a fixed amount over a predetermined period of time, just like EMI, so that your payment will always be the same. Advantages of cash flow loans. For cash flow based loans, the loan amount is based on company's actual revenue generation and capacity to repay. Furthermore, the repayment schedule is based on the timing. For this loan, collateral can be taken, however, it is not the primary consideration for the loan. One of the advantages for cash flow based lending is that loan size, terms, and repayment mode are all based on company's actual cash generation, and hence the risk of default due to diversion of funds is minimized. It's important to note that cash flow based lending is best suited for short-term working capital loans because these types of assets are a generating source of repayment together with profit. So what are the disadvantages of cash flow loan? The cost of cash flow loan. Because cash flow lenders don't scrutinize borrowers in the same way as traditional lenders do. These loans tend to be riskier investments. To make up for that, they charge higher interest rates and other fees. Not only are the interest rates on cash flow loans high, most of them come with heavy fees. Most cash flow lenders charge processing fee, which could be as high as 2.5% of the loan amount. There will also be usually a sizable charge for late payments, insufficient funds in your account to cover a scheduled payment. Sometimes cash flow loans are marketed as unsecured business loan, which means you don't need the collateral a bank would require to be approved. This isn't entirely accurate though, because cash flow lenders do require security to lower the risk of losing their investment if you default. Instead of acquiring specific assets from you, they will put a general lien on your entire business. You might also have to sign a personal guarantee for the loan. That means if your business cannot pay it back, you will be personally responsible to do so. One way cash flow lenders cover the interest risk of these loans is by taking payments directly out of your bank account to make sure they get paid back. Depending on the company and your loan terms, a payment might be taken every day or several times a week. Some lenders might go a fixed payment route, wherein they will remove an agreed amount upon each time, and others might take a percentage of your daily credit and debit card sales until the loan is paid off. So what happens is you might borrow money to pay back the money you have already borrowed. Sometimes it becomes a vicious cycle. To keep you in the loan cycle, some lenders will automatically renew a loan if it becomes past due. On the plus side, this would give you more time to pay, but the downside is you are now saddled with additional fees, interest, and a long payment term, making it that much more difficult to catch up and climb out the debt. This is another tremendously important reason to thoroughly read a loan agreement before you sign anything. Also, there are many online lenders who pretend to be lenders, but they're actually brokers. With the brokers in the mix, the middleman adds, and therefore the cost of the loan increases. Now, coming to asset-based lending, an asset-based loan is actually granted based on the value of property offered as collateral. And this usually, the collateral usually is inventory, AR, accounts receivable, or it could be other balance sheet assets like equipment. Asset-based loans basically involve movable assets. Asset-based loans are mainly suited to businesses that have stronger balance sheets and require larger credit lines to grow without being constrained to future projected revenue or EBITDA assessment. The most typical type of ABL is made against businesses' AR. Other assets that can comprise a facility include inventory, capital equipment, and real estate. Because receivables have greater liquidity, they are frequently the largest proportion of collateral for these loans and provide a high advance rate, typically in the range of 70 to 90% in case you have credit insurance. Contrast to that, inventory, which has a typical advance rate of about 50%, but again, that is industry dependent. If you had, for example, if you had an inventory and equipment, the lender might grant you a fixed limit of up to, say, 10 million rupees against these assets, and a floating limit of, say, or 15 million rupees against your ongoing receivables, giving you a total credit limit of 25 million. The benefit of receivables balance is that it's not tied to the fixed assets of the business, and as sales increase, so will the amount you can borrow. Of course, capped to the maximum facility amount. So businesses that qualify for this type of loan typically pay a much lower interest rate than a cash flow loan due to assets that are offered as security. So what are the main characteristics of an ABL? The main characteristics of ABL are it is often thought of as an option in stress situations or for more highly leveraged companies that might be going through a merger, acquisition, or a period of high growth. Simply put, if the traditional bank says no, that's when it's time to call an ABL. Moreover, a lot of companies that would qualify for traditional bank financing choose an ABL solution due to the flexibility that it offers. If companies qualify for a traditional bank loan and have plenty of financing options, why would they choose an ABL? Here are some of the main differences between asset-based and traditional bank alternatives. The focus is on asset values. While asset-based lenders tend to focus on companies' ability to cash flow, the first step is typically to get a solid understanding of its assets. The level of cash flow and asset coverage usually drive the type of credit facility that will be a good fit. If cash flow is negative, but there is an abundance of collateral and a justifiable story, an ABL solution is often a better solution. Less focus on balance sheet, leverage, and EBITDA details. So while they keep these basic benchmarks in the mind, ABL lenders rarely require a balance sheet or debt to EBITDA covenant. Fewer financial covenants in general. Due to the fact that ABL lenders take some comfort in having adequate asset coverage, they're typically more measured in their approach to working through business cycles. So one of the covenants that they generally have is fixed charge coverage or a springing covenant is very common. Because of the heavier reliance on the underlying asset of business, the personal guarantees are typically required much less frequently. That could be in a case where your business credit score is really, really low. So in that case, they might need a personal guarantee. Otherwise, you could get away without a personal guarantee. Potentially higher advance rates, depending on the situation, and ABL can often offer higher advance rates than a traditional bank alternative. That said, if a bank has been overly aggressive and has ignored items that should be considered ineligible for borrowing base, like past due receivables or slow-moving inventory, the opposite can also be true, which could introduce challenges to present a viable lending alternative. ABL is a longer term solution because sometimes it is also referred to as evergreen loan. Most ABL lending alternatives offer a 3 to 5 year term as opposed to 1 year term, which is generally the traditional banks offer. This can allow a company to take advantage of today's attractive market conditions for a longer time. You are rest assured for a longer period. What are the advantages of ABL? ABL's popularity among borrowers is mainly due to the items listed in the slide. ABL provides ready cash to support liquidity needs, thereby eliminating the need to wait for collection of receivables. It also provides important funding for companies in cyclical or seasonal industries by providing liquidity during slow sales periods and periods of inventory buildup. This could be with the help of over-advanced feature which is there in ABL. ABL provides rapidly growing companies the cash to fund growth or replenish internal capital used to fund growth by financing increases in receivables and inventory. ABL facility is typically underwritten with limited number of financial covenants. The risk this poses to the bank is mitigated by the conservative advance rate against liquid collateral, strong collateral controls, and frequent monitoring. Borrowing terms and repayment schedules generally provide more flexibility and can be customized to fit the individual business requirement or business cycle. ABL borrowers in many cases can monitor availability on a daily basis. For lenders, ABL can be profitable, well secured, and low risk line of business if strong controls are established. So what are the disadvantages of ABL? ABL can present disadvantages for the borrower and the lender. The borrower and ABL facility is often more expensive than other types of commercial lending. Interest rates and loan fees are generally higher, Revolver plus 3 to 4%, and the costs associated with frequent reporting requirements are greater because you need to monitor your collateral on an ongoing basis. Despite this, sometimes ABL may be most economical type of financing available to a borrower in a particular situation. Another potential disadvantage to the borrower is that the loan agreements typically allow the lender to take control of the borrower's cash. It is referred to as Lockbox mechanism, wherein the entire receivable, entire collections on invoices are directed to an account which is called Lockbox Dominion on Cash. That way, the lender ensures that the collateral collection is being applied to the loan and the loan amount comes down. For the lender, the administration and monitoring of ABL is time and cost intensive and particularly susceptible to borrower fraud, especially when a business experiences unpredictable cash or financial troubles. So what's the catch here? In exchange for increased flexibility, the ABL lenders typically monitor the performance of a company more closely to increase frequency of financial reporting frequency. Often it could be monthly or weekly and sometimes even daily if you are high-risk client. Collateral exams are typically 2-3 times a year and dominion of cash through use of Lockbox. Depending on the situation, the complexity of the legal documentation process can also differ. In many cases, borrowers already generate most of the reports and ABL may request. In addition, many borrowers come to appreciate this discipline introduced by ABL facility. So what's the difference? Now we are coming to what's the difference between ABL and asset-based. Cash flow lending allows individuals or companies to borrow money based on the projected future cash flows of a company. Asset-based lending allows companies to borrow money based on liquidation value of the assets on its balance sheet. So the basic difference here is the first one is actually assuming that it's a going concern, and the second one is always with the assumption that it's a liquidation scenario. So what will happen if this company is to liquidate today? That's the mindset you have when you are an ABL. A second important characteristic is the cash dominion. As I mentioned earlier, asset-based lenders tend to require the borrower to have payments on its invoices remitted directly to a bank account controlled by the lender. This blocked account is swept daily so the excess funds can be moved to an operating account used by the borrower. Continuing on the differences, cash flow versus balance sheet lending. Borrowing money for your company isn't as simple as just walking into bank and saying you need small business loan. What will be the purpose of the loan? How and when will the loan be repaid? And what kind of collateral can be pledged to support the loan? These are just a few of the questions that lenders will ask in order to determine the potential credit worthiness of a business and the best type of loan for your situation. Different types of banking business financing are offered by different lenders and structured to meet different financing needs. Understanding the main types of business loans will go a long way towards helping you decide the best place you should start your search for financing. So to illustrate an example, I would say, let's take an example. Suppose ABC company has just landed a $12 million contract that will pay out in equal installments over next year, resulting in $1 million of revenue per month. It will take 12 months for the full contract amount to show up on the company's income statement and for a bank to recognize it as cash flow available to service debt. However, an asset-based lender would view this as receivables sitting on the balance sheet and consider lending against them, depending on the creditworthiness of the debtor company. In this scenario, a bank might lend on the margin generated from the contract. Say at 10% margin, a bank lends at 3 times margin, might loan the business $300,000 because it looks at the trailing cash flow stream, which is $1 million every month. Whereas the asset-based lender could potentially loan the business much more money, perhaps up to 80% of the receivables, so that would be $800,000. So in this example, clearly, I mean, if you were to make a choice, I would go with ABL, given other things are within my reach, because I would get more cash upfront. So what happens is banks lend money based on cash flow, looking primarily at the business income statement to determine if it can generate sufficient cash flow in the future to service the debt. In this way, the banks lend primarily based on what a business has done financially in the past, using this to gauge what it can realistically be expected to do in the future. It's what we call looking in the rear view mirror. In contrast, the commercial finance asset-based lenders look at the business's balance sheet and assets. Primarily, it's AR and inventory. They lend money based on the liquidity of the inventory and quality of the receivables, carefully evaluating the profile of the company's debtors and their respective concentration levels, because again, concentration is a risk from the ABL perspective. ABL lenders will also look to the future to see what the potential impact is to AR from the projected sales. This is what is called as looking out the windshield. The other main difference between bank loan and ABL is how banks and commercial finance asset-based lenders view the business's assets. Banks usually only lend to business that can pledge hard assets as collateral, mainly real estate and equipment. They prefer these assets because they are easier to control, monitor, and identify. Commercial finance asset-based lenders, on the other hand, specialize in lending against assets with high velocity like inventory and AR. They are able to do so because they have the systems, knowledge, credit appetite, and controls in place to monitor these assets. All right, so what we're trying to present with this slide is that, for example, suppose a company XYZ has an opportunity for a $3 million sale, but it needs to borrow $1 million in order to fulfill the contract. The margin on the contract is, say, 30%, resulting in $900,000 profit. The company doesn't qualify for a bank loan, but it can obtain an asset-based loan at a total cost of, say, $200,000. However, the owner tells his sales manager that he thinks the ABL is too expensive. Expensive compared to what? That's the sales manager asks. We can't get a bank loan, so what's the alternative to ABL? The alternative is not landing in the contract. Are you saying it's not worth paying $200,000 in order to make profit of $900,000? In this instance, saying no to ABL would effectively mean the business will lose $700,000 in profit. So what we're trying to say here is we should compare apple to apple, not apple to oranges. So traditional bank lending and asset-based lending are really two different animals that are structured, underwritten, and priced in totally different ways. Therefore, comparing banks and asset-based lenders is kind of like comparing apples and oranges. Unfortunately, many business owners don't understand these key differences between bank loans and ABL. They try to compare them on apple-to-apple basis and wonder especially why ABL is so much more expensive than bank loans. The cost of ABL is higher than the cost of bank loan due to high degree of risk involved in ABL and the fact that ABL has invested heavily in the systems and expertise required to monitor AR and manage the collateral. For businesses that do not qualify for a traditional bank loan, the relevant comparison isn't between ABL and a bank loan. Rather, it's between ABL and one of the other financing options, say friends and family, venture capital, or mezzanine financing, or it might be between ABL and foregoing the opportunity altogether. So if you have shied away from pursuing an ABL from a commercial finance company in the past because you thought it was too expensive, it's time to look at ABL in a different light. If you can obtain a traditional bank loan or line of credit, then you should probably go ahead and get it. But if you can't, make sure you compare ABL to your true alternatives. When viewed in this light, an ABL often becomes a very smart and cost-effective financing option. Generally, asset-based lender has a first security interest in the collateral. The assets examined by the lender offering asset-based loans will vary somewhat, but lenders all tend to look at the same general types of collateral. In an asset-based loan, typically are any income expected from AR, real estate owned by the company, company equipment, and inventory. The asset-based borrower agrees to make the bank the first security interest in these assets in the event that the borrower defaults on loan payments. So what happens is, because the lender has a first security interest, they are senior in terms of receiving funds in the event of liquidation of the company. Cash flow loans don't require this collateral. Instead, they are based on the expected income of the company and its credit rating. So this is one of the features of ABL, that the lender is generally the first security interest holder in the collateral. The ABL can be structured in different ways. These two are the main ways it can be structured: as a revolver or as a term loan. A revolving line of credit is the most common type of ABL to speak about. The facility allows the borrower to draw funds, repay draws, and redraw funds over the life of the loan. So a revolver is commonly used to finance short-term working capital, most notably inventory and AR. Cash from sale of inventory and collection of receivables is a typical source of repayment for a revolver. A borrower that has substantial working capital needs, such as wholesaler or distributor or retailer, frequently uses a revolving credit. A service company may also rely on a revolver to fund AR. A revolver is generally secured by working capital assets such as AR and inventory. The value of the underlying assets determines the loan amount and the availability of the funds. Typically, a borrower can draw against the revolver as many times and as often as needed, up to the lesser of the available borrowing base or the revolver commitment amount. So you have a fixed facility amount and you have a borrowing base. I'll come to borrowing base in the further slides. The outstanding balance of the loan should fluctuate with the cash needs of the borrower, subject to the availability constraints of the borrowing base. Credit availability is restored when principal is repaid from the conversion of assets to cash, and collateral is restored to the borrowing base. The borrower must comply with the terms and conditions stipulated in the loan agreement, including lender controls and treatment of cash proceeds for credit to remain available. In general, cash conversion proceeds are applied to the outstanding balance of the revolver when received. So what happens is, a revolver is like you can borrow as many times as you want. Once you repay the loan, you again redraw, you again repay, again redraw. It's like you have like interest system. You pay it back and you have the full amount back. There could also be over advance, especially when the business season is slow and it's going through a cyclical seasonal business. So there is an over advance feature. An over advance is a loan advance that increases the loan balance beyond the amount supported by the borrowing base. The primary source of repayment for over advance is typically the company's operating cash flow. So ABL facilities may include a pre-approved seasonal over advance for a brief period during the normal operating cycle when seasonal inventory buildup exceeds sales. You are preparing for your next season. In this situation, the bank increases the availability under the borrowing base for a defined period before the peak selling period. For example, a lawn and garden equipment manufacturer may require additional credit availability during the winter months when the sales are slow and the inventory is accumulated for spring supplies. Over advances are also extended for other purposes, such as take advantage of freight discounts or to finance other assets. Other structure of ABL is a term loan, wherein banks frequently make term loans to ABL borrowers. The term loans commonly finance capital expenditures with the financed assets securing the loan. So there could be a term loan for machinery and equipment if the company wants to buy a bulk of machinery and equipment. So the asset is the machinery and equipment itself. In ABL financing, however, term loans may be part of large structured financial transaction that combines ABL with other secured or unsecured debt. So what happens is when you have a large loan, there could be ABL for AR, inventory, and also a term loan for equipment. And there could be an over advance for a specific period of time in case you need it. I mean, you have to talk to your relationship manager, explain them the business cycle in order for you to have that over advance for a particular period of time. So before we get into borrowing based calculation, I would like to quickly breeze through some jargons that are used in asset based lending so that you are with me and I don't lose you down the line. A revolver differs. What is a revolver? A revolver differs significantly from a term loan. The loan balance in a revolver typically is secured by receivables and inventory, which can fluctuate daily. With a term loan, the outstanding balance is fixed for a period ranging from months to several years. A term loan has an agreed upon repayment schedule. Generally, once an amount has been repaid in term loan, it cannot be reborrowed. Whereas in a revolver, the company can borrow, repay, and reborrow as needed over the life of the entire loan facility. Lockbox. A typical agreement gives the ABL lender control of the company's incoming cash receipts from the customer. A lockbox or blocked account is established by the lender for the receipt of collections of the AR. The lockbox account usually is created at the bank where the borrower does the business. The company's customers are instructed to pay their accounts by mailing remittances to the lockbox. This is generally mentioned on the invoice and in the face of the invoice itself. These payments are deposited in a special account set up by the lender. The lender credits this fund against the loan balance. So whatever amount has been collected in this blocked account or lockbox account, that is applied to the loan at the end of the day, just swept to the loan balance. The lender credits this funds against the loan balance. The lender then makes new advances against the revolver as requested. So at the end of the day, whatever collections you have received from AR, you sweep it to the loan amount, and then the loan amount is dropped down, it's reduced, and then whatever you need to borrow, you again make an advance and request. So that's how a revolver works and how the lockbox mechanism works in the ABL. So I just explained the lockbox, wherein the funds are moved to a blocked account, wherein it can be withdrawn only to pay down the loan balance. You cannot withdraw money from a lockbox for your operating purposes. Advance rate. The amount that can be borrowed is based on the advance rate set by the lender. The advance rate is the ratio between the amount the lender is willing to lend against a particular eligible asset and the total value of that asset as determined during due diligence. So what happens is, depending on the dilution that is there in the AR and the inventory ineligibles, the borrower comes up with advance rate. It could be a lower rate, say 70-75%, wherein you have a dilution of about 10%, or if you have dilution below 5%, it could be as good as 85%. And if you have credit insurance, it could be as good as 90%. So basically, advance rate is a percentage, a fixed percentage which a lender fixes. Like if you have X amount of collateral, I will advance you say 85% of your AR collateral. So that 85% is the advance rate. Dilution. The aggregate value of shortfall between the amount invoiced by a borrower and the amount actually paid by that company's debtor. The delta is called dilution. Typical dilutions are credit notes, settlement discounts, and any debit note. What happens is this dilution generally refers to difference between what you have invoiced and the actual cash you collect from your customer on that particular invoice. Factors such as bad debt write-off, warranty, returns, invoicing errors, trade discounts. So basically anything other than cash, if you credit to your debtor, then that is what adds up to dilution. Dilution is expressed as a percentage. Dilution is important because the lender uses it to establish the advance rate. So I'm going to try to demonstrate this terminology with an example. A company, for example, bills $1 million to its customer for invoices. Of that, $930,000 is eventually collected. So I have not collected $70,000. $20,000 is on account of return goods, and $5,000 is subtracted for early payment discount. And say another $45,000 is a bad debt write-off. So, in total, I have collected $70,000 less. So the dilution in this case is $70,000 divided by $1 million. So that will be 7% dilution in this case. So now what happens is typically since the dilution is about 5% in our example, the advance rate will be adjusted lower. Generally, if the advance rate is generally 85% for AR if the dilution is within 5%, 4 to 5% bandwidth. But if you have anything over 5%, then for example, in this case, it could be anywhere from 80 to 82%. The advance rate could be 80 to 82%. What is eligible receivables? Not all receivables qualify for inclusion in the borrowing base. So you have gross receivables, and then you have something which will be excluded from the borrowing base. You cannot borrow on X, Y, Z for X, Y, Z reasons. So not all receivables qualify for inclusion in the borrowing base. Examples of receivables that would be ineligible are, for example, 90 days old, anything which is over 90 days, given that the general credit term is 30 days. Generally, 3 times the general credit term is what is considered past due for ABL purposes. Related party receivables, because this is just left pocket, right pocket. You're just moving funds from one company to another. So no lender is going to lend you for receivables to be received from your own related party. Borrowing against federal accounts, so government receivable, if you have any, then there's a special assignment of claims to be filed, which banks would generally want to avoid, and they generally straight away remove this kind of receivable from the borrowing base because they don't want to get into following up with federal government in a liquidation scenario. There may also be restrictions on receivables generated from foreign sales and receivables to companies that both buy and sell from the same party. So it's a contra relationship wherein the receiver, the AR and AP is from the same supplier and creditor, supplier, customer, in the same party. Because in the event of liquidation, this particular customer is not going to pay you. They will say, hey, look, you have to pay me for whatever you have procured from me. So I'm going to deduct this amount. I'm not going to pay you that. So that way, a contra is also kind of removed from borrowing base because that is not going to be collected in the event of liquidation. As I mentioned earlier, the ABL always follows the liquidation scenario. And I will always have that pessimism that, if I go into liquidation tomorrow, if this company goes down today, what is going to happen with my AR, which AR I'm going to be able to collect, what I'm not going to be able to collect. So what I'm not being able to collect is what comes out as ineligibles, and what I am comfortable collecting is called eligible AR. So now I'll take you to an example of calculating eligible AR. Okay, so here what we have is a small table here for calculation. To start with, we have a gross AR balance of 20 million, and we are going to show, it's just hypothetical numbers. The indications here are past due over 90 days. Given that the general terms is 30 days, the past due over 90 days will come out as ineligible, in our example, 125,000. Cross age over 50 days. Now, what is cross age? What over 50% is what is written over here. So that is the terms. 50% cross age comes out as ineligible. So in this case, for example, a customer X has a total receivable on my balance sheet of say $100,000. That customer has more than say about $60,000. $60,000 is say over 90 days past due. So that is over 50%, right? $100,000, 50% of that is $50,000. If I have a past due from that particular customer, which is over 50%, then the entire balance of that customer is ineligible. So for example, if it is, in my example that I mentioned, $100,000 is the total receivable from customer X, more than 50% of that, say $60,000, is past due over 90 days. Only 40,000 is current AR. So because of the virtue of cross age over 50% is ineligible, by that virtue, the remaining $40,000, which is current AR, will also be held ineligible under the category credit cross age over 50%. So credit balances in past due. Now what happens is we are taking out all the past dues as ineligible. Whatever is the negative balances, that is the credit balances, they are actually reducing my past due balance, past due ineligible. So I'm going to add back that. So that is going to be credit balances in past due added back. Contra offsets to payables, which I just took up a slide before, that if you have an AR and AP relationship with the same party, then because that party is not going to pay you at the end, so we are going to remove it as ineligible. Dilution reserve 3%. So anything over 5% is held as reserve. So in my example, for example, if I have say 8% dilution in this particular example, then 8 minus 5 is 3, and therefore 3% will be held as dilution reserve. So adding up the total ineligibles in an example, so $375,000. So net eligible is $19,625,000. And say the advance rate on this particular facility is 85% of AR. So I have an availability of $16,681,250. However, my facility limit, my facility amount, my total loan amount I cannot exceed is 15 million. So my availability in this particular example will be capped at 15 million because I cannot borrow more than what I have been approved. So my approval of facility is about 15 million. So I'll not be getting anything more than that. So in this example, I have an excess availability of 1681250. Anything over my facility limit, I have availability, but I could not take it, so that's an excess availability. So I'm going to take up next terminology, which is eligible inventory. Eligible inventory includes finished goods and marketable raw materials and excludes WIP, slow-moving goods. There could be additional limits on the advance rate for specifically manufactured goods that can only be sold to a specific customer. So for example, if there's any customization done on goods, there is no ready market for it to liquidate, and therefore it comes out as ineligible. So basically the simple logic over here, you know, like if you have an inventory which is a commodity, it's very good for ABL because you can liquidate in an open market in an orderly liquidation mechanism. You can fetch very good price of it. So it's good for the lender. Whereas if you have any customized goods, you have customized for a particular customer, he wants something tweaked in the goods for him, or say for example you have imprinted his brand on your product, on your inventory or packaging. So what happens is this particular product I cannot sell right away. I will have to do some processing. I will have to remove the packaging. I'll have to unpack or maybe pack, repack in a different package for it to be able to liquidate in the open market. Because what happens is work in process, I mean in a liquidation scenario, I'm not going to be able to run the plant and finish the processing of the remaining products. So I'm going to yank out the entire WIP out of my borrowing base. Slow moving goods, again, if the business was not able to sold as a going concern, how am I going to be able to sell it in a liquidation scenario? So again, that is another candidate for ineligible category. So very simple. I mean, if you are to think as a lender, whatever doesn't make sense, whatever you think cannot be sold readily is a good candidate for ineligible, and it could be reduced. Your collateral can be reduced to that extent. The borrowing base can be reduced to that extent because, as I said initially, that your mindset is that tomorrow if this company goes down, then what is going to happen to my collateral? How much I'm going to be able to recoup out of this? That is the thing that you enter as an ABL auditor. So now taking up the example on inventory availability. So for example, in this example, we have gross inventory of say $5 million, and there are ineligible categories: obsolete inventory, slow moving, packaging. Again, packaging is very specific to a company and it cannot be sold as such in the open market. It will not fetch any, I mean, it might fetch peanuts, but it will not fetch the amount that is there on your books. So that's why there is also an ineligible category. Work in progress is another category. Off-site, third-party location, inventory lying at off-site. So what happens is, if your inventory is not in your warehouse, to which your lender has access, because your lender will generally have free access to your warehouse or your leased property wherever you store your inventory. Because this particular inventory is not lying in your facility, the lender will not have access to this inventory, and therefore it is a good ineligible category. So after reducing all these categories from the gross inventory on your balance sheet, you'll arrive at what is eligible inventory. So in our example, $4,480,000. And if the advance rate, the terms sheet says that the advance rate is 85% of NOLV. NOLV stands for net orderly liquidation value. So what happens typically in an ABL, the inventory NOLV is assigned by appraisers. The appraisers generally appraise the inventory because different industry segments, different businesses have different kinds of inventories, and it is not easy for a layman or a lender to understand the nitty-gritties of inventory and how this inventory will behave in a liquidation scenario. So lenders generally get inventories appraised, and the appraiser will tell them, like, in a net orderly liquidation scenario, what will be the value fetched for this particular piece of inventory, this kind of inventory. So in our example, say the NOLV percentage by the appraiser given is 72%. So as a lender, I'm willing to advance 85% of the NOLV, so that is 85% of 72%, so that is 61.2% in my example. So that will work out to an availability of $2,741,760. So again, the limit of facility, the facility limit, for example, here is say $2.5 million. So the availability is capped at $2.5 million here, because you definitely cannot borrow more than what is approved to you. Borrowing base calculation. So again, I have picked up an example over here. So first, what is borrowing base? Borrowing base. The borrowing base certificate is a form which is prepared by the borrower and submitted to the lender periodically. It could be as often as daily, or weekly, or bi-weekly, or even monthly if you have a good credit risk rating. So it reflects the current status of lender's collateral. This certificate should be compared to balance sheet for consistency. I'm going to right away go to example. A company has a revolving line of credit with an ABL for a maximum amount of $10 million. The agreement provides for an advance rate of say 85% of eligible AR and 60% of eligible inventory. So the agreement provides that eligible receivables consist of balances that are null, and that eligible inventory consists only of finished goods. The AR at the end of the period is $5.5 million, with $500,000 over 90 days old. Inventory is $10 million, of which $6 million is finished goods. So in my example, I will take down the solution to the next page. So in this case, the AR, after reducing the ineligible $500,000 at the rate of 85%, will be $4 million to $50,000. The inventory, 6 million into 60%, for example, the NOLV 85% into NOLV say 60% in our example. So that is $3.6 million. So the total available is $7.85 million, but the maximum line limit is 10 million in our example. So I'm going to be able to borrow only 7.85 because that is what is availability for my purposes. If I were to be over 10 million, then I would be capped at 10 million because I cannot borrow any day more than what I am approved. So because the total available is 7.85 million is less than the maximum line, 10 million, assuming that the company has borrowed the total amount which is available, that is 7.85, the loan is considered to be in formula. So we are within the formula. I'm going to twist this example a little bit, and we'll see what happens if the amounts change a little bit. So if in the same example, say the eligible AR were $8 million. So what will happen? 8 million into 85%, so that is 6.8 million. Inventory is 3.6 million, same from the last example. So total is $10.4 million. And the maximum line, the facility is $10 million. So the excess capacity above line limit is $400,000. In this case, because you have borrowed more than what your facility limit is, you are over advanced and you are out of formula. So what happens is in this scenario, in this case, is either you have to straight away pay the difference. I mean, you have to make good whatever is over advance, that is 400,000 in our example, or you will be levied fees and penalty for being over advance. Your covenants might get strict, your risk rating might increase. So this kind of steps can be taken by the bank when you are out of formula for a longer period. Is ABL suitable for you? That's the question. So broadly speaking, ABL is suited to companies with low margins and large balance sheets, or companies that have been inconsistent EBITDA. If you have EBITDA, you can go for cash flow. If you do not have EBITDA, then you go for ABL. These companies, including many retailers, distributors, and metal companies, don't have enough EBITDA to support cash flow-based borrowing for inventory. The EBITDA margins may be as thin as say 5%, but ABL allows them to tap into their large balance sheets since the amount of credit extended by lenders is based on the liquidation value of the assets owned by the business. So it is not suitable. ABL is not suitable for all businesses, just as cash flow based is not possible for every business. In a cash flow based loan, the company's credit rating plays a key role in determining how much of its business can borrow in the first place. These loans are more suitable for businesses with high credit ratings and large amount of documented cash flow. Asset-based loans are more suitable for borrowers who may have lower cash flow or poor credit rating. The value of asset needs to be substantial enough for the bank or other lender to risk the loan. Is CFL right for you? Cash flow loans are suited to high margin companies or ones that have little in the way of assets to use for collateral. Indeed, if the company has few hard assets to back up an ABL facility, a cash flow loan may be the only option. These loans are based on the company's projected future cash flows with the lending limit set at the enterprise value of the company, including its ability to generate cash rather than the value of the assets of if liquidated. These companies, such as service companies, marketing companies, may generate EBITDA in the range of 15 to 25%, which is enough to secure an adequate cash flow revolver to support the business. So the bottom line here is, when a company or individual needs a loan in order to conduct short-term or long-term business, they have two primary options to borrow money. These two types of loan have a variety of different qualities. Cash flow lending has a higher emphasis on the credit rating of a person or organization and expected cash inflows to the balance sheet. So there's a more weightage to cash flows rather than balance sheet. While the investors with lower cash flows, weaker credit ratings, or robust AR lines on their balance sheet might obtain financing through an asset-based loan. However, the asset values typically must have significant value in order for a lender to take the risk. So it depends what you have to offer to the lender, and that is the right type of loan for you. So you have to take your pick. As noted, some companies are naturally suited to either an ABL or a cash flow loan, but most companies must decide between the two. Ideally, they should speak with the lenders that offer both products and can lay out the pros and cons for each for a specific company's particular situation. It's also important to choose a lender that understands the borrower's business, the dynamics of the industry, and the competitive landscape. The fact is that some companies that set up a 5-year cash flow revolver will breach a covenant at some point during this period. The fast-moving pace of today's business environment means that some unexpected event is bound to occur that affects financials. For instance, a covenant might permit only spending $5 million on capital expenditure, but if there's an opportunity to buy a competitor for say $10 million and build a business, the company may want to renegotiate the covenant with the lender. The question every CFO should ask is, which lender do I want to work with if that day arrives? Finally, if you have any questions, I'll be happy to take them. Is ABL an organized sector in India? That's the question I have on screen right now. So I would say it is kind of emerging. It is there, but it's not in a big way in India yet. There is, I would say there is a organization which is created for it so that the lenders can actually file their security interest, wherein they can actually register that they have first security on this particular It is there, but it is not called ABL. I mean, a lot of small businesses actually have a working capital loan with the bank, wherein AR and inventory is there, but it's not in a big way. It's not very known kind of loan in India. It's not marketed very well, I would say. But there are efforts being put out by IFC to kind of organize this sector in a big way. Since 2007, they are working on certain committees. Currently, India's financial institutions can secure the lending by registering their security interest on a borrower's movable collateral with a central database, which is the Central Registry of Securitization, Asset Reconstruction and Security Interest, shortly known as CERSIA. Any other questions? Which one is cost effective? The question is, which one is cost effective? So I would say if you have the cash flow and if you have good credit rating and if any lender or any traditional bank is willing to give you a loan, go for cash flow loan. Because if you have it, just get it. If no one is giving you loan, and that is the time you actually ring up an ABL and you tell them, look, this is what I have on my balance sheet. Can you give me some money based on this? So that is what an ABL is. And sometimes even if you have all the bandwidth to get the cash flow loan, still if you need the flexibility, like, you don't want to draw down the entire amount as it is in the cash flow, you want to draw whatever you want and whenever you want, then that flexibility is available in ABL. So to answer your question, Vishnu, the cost-effective mechanism will be cash flow compared to ABL, because ABL is actually risking what it will be able to fetch from your receivables and inventory in future. Its monitoring cost is much higher, and that's why it comes as an expensive type of loan. Sometimes what happens is, even if you have all the possibility of getting cash flow, you might not want to go for cash flow, is when you have the stringent covenants wherein you need to maintain your debt service ratio should be 1.5 to 1. If you cannot maintain that, then you cannot get the cash flow loan. So in those scenarios also, an ABL will be helpful, because your debt coverage ratio is not as high as cash flow loan in case of ABL. So if we don't have any more questions, I would like to say thank you to everyone for your valuable time and being with me.